It's Brian Preston, the money guy.
All right, this next question is from Mark P. And Mark said, is there a rule of thumb or percentage you should have in each bucket? And he said Roth, deferred 401k, and brokerage. So, one of the things we always talk about is when you get to retirement, we want you to build up three distinct tax buckets. We want you to have your pre-tax bucket, which is like your pre-tax 401ks and your IRAs. We want you to have your tax-free bucket, which is your Roth IRAs or your Roth 401ks and your health savings accounts. And then we want you to have your after-tax or your taxable bucket, which is like a regular brokerage. So Mark's question is, okay, you told me to do these three buckets. Well, how much should I have in each? And how do I know what makes sense? And is there like a rule of thumb between once I fill this bucket up, I should shift to the other one? How should Mark think about that?
It's funny you say rule of thumb, because what does a thumb have? A thumb has a fingerprint on it. And just like fingerprints, just like snowflakes, no two are the same. And we see this, I'll tell you, working with clients all across the country. I never know. It's the whole Forrest Gump. It's like life is like a box of chocolates. Right. You don't know what you're going to open up with every client that comes to see you, because some of you might have a retirement plan that is just so generous that you're going to, but it doesn't have a Roth savings option, that you might have so much money in tax deferred that you feel kind of retirement rich, life poor.
That's right.
But it's just the way life worked out, and you couldn't pass up all that free money the employer was coming. And then some of you, maybe you sold some land, or sold a business or something where you have all this after-tax money. It doesn't mean that you neglected the three buckets. It just means that you, as you were going through your wealth journey, different opportunities presented themselves. Now, as you're on this journey, I want you to at least understand those three buckets that Bo talked about: the after-tax, the tax-deferred, and then the tax-free, so that as you're navigating those things, yes, take advantage of them, but at least pay the respect that, man, is this an opportunity to get a little more tax-free? For instance, you make too much money for Roth IRA contributions. You're in a high-income situation, so you want to do the tax-deferred with your 401k. But why couldn't you do a backdoor conversion strategy to slowly but surely get some tax-free money if you have the right structure? Those are the type of opportunities I want you to take. But I can't tell you do 25% here, 40% here, and then another 35% over here, because everybody's just so unique and different.
Yeah, I hear this all the time. And a lot of people think, okay, on day one of retirement, I've got to have it perfectly equalized. I got to have 33%, 33%, 33%. We see this all the time where someone will reach out to us in their late 50s, mid 50s, late 50s, and say, guys, I wish I would have found your show 20 years ago, because here's what I did. I didn't know any better. I got a lot of money, got 7 figures in my 401k, but it's all pre-tax. And I didn't know what else to do. I've got some IRAs from an old thing, so I couldn't do Roth because I make too much, and I couldn't do backdoor Roth. And I got a lot of money in my after-tax. I've only got these 2 buckets. And I hate it, because I hear you guys talk about how Roth IRAs are so good because they don't have RMDs and because it's really good from an estate planning standpoint. And I feel like I'm stuck. I feel like I missed the boat. Well, one thing we tell them is, hey, just because you weren't able to build those 3 buckets before you got to retirement doesn't mean you're not going to have the opportunity in retirement to still structure your 3 buckets. We see it all the time where someone is unable to build Roth assets while they're working for any number of reasons. But then when they retire, if they retire early before age 72, and they have the other 2 buckets built well enough, they can do a Roth conversion, not a backdoor Roth, but a true Roth conversion strategy to begin converting pre-tax dollars to Roth dollars that, while they might not have started retirement with all 3 buckets, by the time they're a decade in, 15 years in, 5 years in, they've been able to start building those 3 buckets. So you do the best that you can while you can with what you have, and it's okay if it's not perfectly prescriptive, nice, even chunks.
I do want to give a word of caution, because I think that a lot of my hyper-successful people, when you get executive level or work for a bigger company, after you get past maxing out your 401k, they're going to start, once you're in a higher income situation, start offering you deferred comp and other things. And you're going to start going, whoa, man, I love saving money from taxes. So you end up and you get to that point, like you said, Bo, you're in your 50s, maybe even approaching 60s, and you go, I have no money in after tax, meaning just a brokerage account. So if I want to pay cash for that car, I've got millions of dollars over here.
Can't get to it.
I don't have access to anything I can get my hands on. I'm telling you, when you reach those decision points, when they start offering you deferred comp and all the other options at your workplace, I need you to kind of create a plan. This is the value of maybe it's time to go seek the help of a professional, is because this is exactly what we do, is try to help our clients navigate how much is, don't let the tax tail wag wag the entire dog of your financial life, so that you don't have any access to money outside of just your retirement assets. Because I do think that's something I see all the time, especially with financial mutants, because you love minimizing the taxes, but you minimize yourself into a corner where when you have options to retire early and so forth, yes, you could get to the money pre-59.5, but you just regret every part of it because all of it's going to be taxed at ordinary income tax rates, and you just don't love the situation you've created. There's everything that you do financially usually has incremental decision making or opportunity cost, and you're trying to, as you create a financial plan, is balance the pros and cons of every one of those incremental decisions, so that when you do reach your financial goal that you've set for yourself, you are the best version of yourself. And I think a lot of people, that's going to require some lefts and rights when you have those fork in the road moments to do it well.
I love it.